Welcome to today's Explainer. Today we are digging into a truly fascinating financial mystery, straight from our source material, the Wealth Blueprint. Have you ever caught yourself wondering how some people manage to build this massive wealth while keeping so much more of what they earn, entirely legally? There's this persistent idea out there, right? That there's some sort of secret code only the wealthy know about. But as we'll see, our source material breaks down exactly what's actually happening behind the scenes. We're going to map out how money, businesses, investments, and tax rules all intersect like one giant puzzle. So get ready, because what we cover today might literally change how you view your own income.
Okay, let's dive right into this by comparing two people. We'll call them John and Sarah. Now, they both earn exactly $100,000 a year. On paper, their financial success looks absolutely identical. But at the end of the year, when it's time to settle up with the government, John pays a significantly higher amount in taxes than Sarah does. It's the exact same total income, but drastically different final numbers sitting in their bank accounts. When you see a huge difference like this, it immediately sparks a question, doesn't it? Like, how is that even possible?
The first thing that usually jumps to mind is, did Sarah break the law? Is she doing something sketchy? Well, the source is crystal clear on this. Not at all. Sarah isn't cheating the system. She's not, hiding briefcases of cash in an offshore vault somewhere. She simply understands how the tax rules legally work way better than John does. So today, we're going to reveal exactly how people like Sarah legally reduce the amount of tax they pay, and why most everyday earners never actually learn these specific strategies.
Section 1. The wealthy tax myth.
Now, what's really interesting here is dispelling a super popular myth, the idea that rich people simply don't pay taxes at all. Our source material quickly corrects this. Many wealthy people absolutely do pay taxes. The secret isn't evading taxation entirely. It's actually about the fact that they don't earn their money the same way traditional employees do. That distinction, how the money is actually generated, is the absolute key difference that dictates the final tax bill.
Moving on to Section 2. Salary versus assets.
Let's imagine two friends, Alex and Emma. Now, Alex relies on a traditional job. He works at a company and his income comes straight from his monthly salary paycheck. Emma, on the other hand, structures her financial life totally differently. She owns part of a business and she holds various investments. So her income flows in from multiple streams, like business profits, dividends from stocks, rent from properties, and other investments. Notice the huge contrast here. Alex trades his time for a single paycheck, but Emma holds assets that generate income for her.
And the source ties this all together perfectly with this quote: different types of income can be taxed differently depending on the country. You see, the tax system fundamentally looks at Alex's salary completely differently than it looks at Emma's asset-based income. That right there is exactly why wealthy people often focus their time and energy on acquiring and owning assets rather than just endlessly trying to earn a higher and higher salary. The actual rulebook changes depending on the category of the income.
Which brings us to Section 3, Businesses and Investments.
And this brilliantly illustrates the whole concept. Let's say you own a small coffee shop. To run this shop, you obviously have to buy things, right? You buy tables, chairs, a fancy commercial coffee machine, and of course, you pay rent for the building. Well, in many places, these are legitimate business expenses, and they legally reduce your taxable business profit. You're only paying taxes on what is left over after those expenses are taken out. Now think back to Alex, who only earns a salary. He generally doesn't have access to these same kinds of everyday business deductions. And that is a massive reason why business owners can experience totally different tax outcomes compared to salaried employees.
But it's not just about running a daily business, it's also about where you park your capital. Wealthy people very often invest for the long term. And in many countries around the world, long-term investments receive a completely different and frankly, often more favorable tax treatment compared to your regular everyday salary income. Now, obviously, the exact rules depend heavily on where you actually live, but the underlying principle is universal. Understanding the specific tax rules regarding long-term holdings can make a tremendous difference in your overall wealth accumulation. It's a real game changer.
Section 4. The real estate advantage.
So, property ownership is a major focus for wealthy investors, and for really good reason. Real estate comes with highly specific tax implications. We're talking about how rental income is classified, the deductions you can take for financing costs or mortgages, the money spent on maintenance and repairs, and a really big one, depreciation. Depreciation actually allows owners to deduct the perceived loss of value of the property structure over time, even if the property's actual market value is going up. Pretty wild, right?
Again, the rules vary by country, but these specific levers are exactly why so many investors pay incredibly close attention to real estate when planning out their taxes.
All right, Section 5. Building a financial team.
You might be wondering how anyone actually keeps track of all these rules. Well, the reality is, wealthy individuals rarely execute these strategies alone. They definitely don't just guess at the tax code. Instead, they assemble what the source calls a wealth team. This typically includes 3 key players. 1. Accountants to meticulously track the numbers. 2. Specific tax professionals who deeply understand the local laws. And 3. Financial advisors for big-picture long-term strategy. These experts are the ones who make sure they strictly followed the law while utilizing every available tax rule efficiently.
Which brings us to such a profound takeaway from the source material. Financial knowledge is often far more valuable than income. Think about it. You can have a massive salary, but if you don't possess the knowledge of how to protect and grow it, or the right team to guide you, you're going to end up exactly like John from our very first example, paying way more than necessary. Understanding the financial system itself is a distinct asset, and learning how to navigate it is absolutely crucial for anyone looking to truly build wealth.
This leads right into Section 6, avoidance versus evasion.
So the crucial point here is establishing the absolute legal boundary between financial strategy and breaking the law. Let's look at tax avoidance first. This is simply the process of using legal deductions and incentives provided by the government to plan your taxes efficiently. It is 100% legal. In fact, governments often create these exact incentives on purpose to encourage certain behaviors, like, starting a business or providing housing. When you deduct your coffee shop's espresso machine, you're practicing tax avoidance. It's totally above board.
But we absolutely have to contrast that with tax evasion. Tax evasion is breaking the law, plain and simple. It involves deliberately hiding income, refusing to report cash, or intentionally filing false information with the government. This is strictly illegal and can lead to devastating consequences. We're talking massive fines or even prison time. The source explicitly warns to always follow the tax laws that apply where you live. The strategies we've been discussing today, they are entirely about legal avoidance, never evasion.
As we wrap up this explainer, the source leaves us with this awesome final thought. The biggest lesson isn't to avoid taxes. It's to understand how money, businesses, investments, and tax rules work together. It really hits the nail on the head. There's no secret, hidden tax code just for the rich. They just generally possess better financial knowledge and actively seek out professional advice. They see the entire board, recognizing exactly how a decision in their business impacts their personal taxes and how an investment strategy can legally shield their wealth.
Which leaves us with one final question to ponder. Are you ready to change how you think about income? As you've seen today, relying solely on a salary really limits your options, whereas understanding assets, businesses, and legal tax frameworks opens up entirely new possibilities. It's like a whole new world. The more you learn, the better financial decisions you can make. Thank you so much for joining me for this explainer. Keep learning, keep asking those great questions, and focus on building that financial knowledge. I'll catch you next time.